All right, so you want to buy a business, but you need to know what financial documents should I be looking at to make sure I'm not buying a lemon of a business. You're in the right place. I'm going to tell you the tale of two different prospective business owners today who are looking at buying businesses. One that had a lemon business, the other that had a great business, and how we decided between them which business should be bought and which business should be avoided at all costs so that you can avoid those same mistakes. We're also going to look at the 3 financial documents you need to have in front of you before you decide to buy that next business, and the single most important number you can look at so that you're not making a poor decision. We want you to be an informed investor. Let's dive in together. So I want to start by telling you the tale of a donut shop. We had some franchise owners come to us who already owned a single location. And they were saying, ooh, we really think this is a great opportunity. This other franchise location has come up. We think we should buy it. We already know what we're doing from an operations standpoint. We just think we want to buy this business. Can you just glance at the numbers to tell if it's a good idea or not? Immediately, as we started looking at the numbers, these big red flags were coming up. I'll show you some numbers behind me here in a minute to see what we should be looking at. But it was very clear from the financial documents that this would have been a terrible financial decision. And within 15 minutes, we knew they shouldn't be buying it. They'd been deliberating about it for almost a month between the husband and wife. And 15 minutes later, when we saw the 3 financial documents, it was like, this is terrible. You're going to lose money on it. Don't do it. Now contrast that with another couple that came to me saying, ooh, we want to buy this manufacturing business and we want to know if it's a good deal or not. As we looked through the numbers, there were big thumbs up across the board. It was checking all the boxes. And they bought the business, and now they're working on growing cash flow. So what do we need to look at in order to not buy the lemon business? Let's look at a few of these key numbers. The first numbers that we want to look at come from a profit and loss statement. Profit and loss statement shows what money came into the business, what money went out of the business, and what was left over, that profit. So you want to pull up a profit and loss statement or as many profit and loss statements for years prior in a business that you're looking at buying. Many times the current owners will be required to give you last year's P&L, but I want to see last year and the year before and the year before, as many years as they'll give me. It's often a good indication of how carefully they have taken care of their finances if they're able to give you many years of those documents. Otherwise, if they've run the business pretty sloppily, you might only get the required 1 or 2 years before, and things might look kind of messy. So it's a good indication when I ask, can I see 5 years, 7 years back? If they can produce those easily, it's a good sign they've probably taken good care of the business. All right, so when I'm looking at a profit and loss statement and I'm comparing past years, there's 3 major numbers on there that I'm looking at. The first one is going to be revenue. And specifically, if I can see a month-by-month comparison, that's very best. If nothing else, then I at least want to see year-end numbers. So let's say I've got 3 different years worth of profit and loss statements that I'm looking at. Okay, that first number, revenue, maybe let's say it was there for year 1. Year 2, it was down here. And year 3, let's say it's back up here, or the most recent year, right? I'm wanting to look at trends in the business. So this is why the more years back I can go, the better picture this gives me of where the business is heading. So for example, it might be like this, and I might want to see, hey, why did revenue dip so much in that year? During my due diligence process in buying that business, I'm going to ask the owner, hey, I saw that here in this year, things went down a little bit. Can you tell me what was going on there? And if they say, it was, there's a giant pandemic that hit and everyone's sales tanked and ours did too, but we're rebounding back to where we were before. Okay, I can accept that. If they don't have a good answer for it and they can't explain why and what they've been doing that changed the trajectory of the business, again, that might be a red flag for me in buying that asset. The next number I'm going to look at is a combined total of cost of goods sold and total expenses. So let's say my expenses and cost of goods look like this. And I started off here, I got a little bit higher, but then they've come back down. Now, what I'm nervous of is if there's a trend like this, where I see my expenses are going up more and more each year, which would result in the third number looking worse. So that third number is profit. Revenue minus expenses equals profit. What has been left over each year? I want to see specifically, is profit going down? Was profit negative in a certain year? Maybe it was. If it's negative, I'll just tell you right now, would you want to buy an asset where you have to put more money into it every single year? If that's the case, if their business was net negative or barely break even, I'm going to be very careful about buying this business, and I'll tell you why in just a minute. But if we see a trend like this, in this case, we would have to have expenses greater than our revenue. I'm just really nervous about this. This might tell me that this is a failing business, and I wouldn't want to invest in that. But let's assume for just a minute that, we had some consistent profit going on here, but it's going down just a little bit. I wanted to find out why it's going down. But then more importantly, there's one additional calculation that really matters as we're assessing a business like this. But before we get to that, if you're liking this content, will you just hit that like button for just a minute? We'll put out more stuff like this for you. I love the visuals of understanding a business. And if I can take the financial documents from a business I'm looking to buy and physically plot this out, I might even do it on a paper. I could do it in a spreadsheet or wherever. It will make your life so much easier, and it would make our life so much better if you click the like button. All right, so before I get to that one big number that I really care about looking at, there's one last piece that we have to understand about buying a business. So if my profit and loss statement tells me a history of the profit, then the other document that I'm going to look at, the second one, is the balance sheet. And that gives me a snapshot in time of how much money the business had, how much in debt they also had at that same amount, and the amount left over. So I'm going to be assessing those three things: assets, and I'm looking at it to see if I can get multiple years of balance sheets. I'll be able to see how has your actual cash on hand changed and how has your debt situation changed. That would be important for me to see. Is it getting better? Is it getting worse? A lot of times business owners are trying to sell the business because things aren't going well and they want an out. Do you think that you might want to know that if you're about to spend a bunch of money, time, energy, and lost sleep acquiring a business that's losing a bunch of money? So we want to be very careful about that. Number one, assets. Number two, I'm looking at liabilities. In other words, debt, right? What does the business owner owe on that business? One thing I would really be careful of is a business that has recently taken on a lot more debt. That is a sign that they might be having cash flow troubles and needing debt to make payroll, for example. Or if it's like, I do have more debt, but it's because I bought new equipment and that allows us to be much more productive in what we're doing and we're able to make more profit as a result. Cool, that might make sense, okay? But I'm seeing, do they have new debt on their books? And if I can't tell if it's new or not, I'm going to ask them. I'm going to go to the owner, and as part of my due diligence process, I may ask, tell me about this debt. Why did you take it on? What did it cover? And how much is left on it? The last part is the equity section. And equity is the most confusing part, but it tells us a couple of really important things. There is, under the equity section, a line that will say something like owner's distribution or owner's capital account. And it will be a lifetime total of how much the owner has paid themselves out. I want to see how much have you been paying yourself out, because that's a good indication to me of what I might be able to pay myself out as the new owner of this prospective business. All right, so now the final thing that I would be looking at is the bank account. I want to go see their actual bank transactions if I'm able to. I can see bank statements and look at how much money are you pulling out each month? What about the last 6 months? How has cash flow looked in the business? Have we gotten really tight on how much money is in the bank? If I see a business that has almost no cash in the bank, again, that's a really big red flag to me. I wouldn't want to be buying that, right? It's like you're going to buy a rental property, but it's losing money every month. I don't know if I want that investment. And so a lot of times business owners get very emotionally tied to that business they're about to buy, and they don't look at these numbers. And I have assessed so many businesses where we look at these numbers and it's like big thumbs down, don't do this. We have to separate our emotions from this transaction and look at it from a do the numbers make sense standpoint. Okay, the very final thing, one bonus nugget here, is I would be looking at the profit and loss statement and I would be looking at the balance sheet and I would ask myself, if they have this much profit, let's call it, I don't know, $10,000 of profit per month in here. I'm going to see that number and think, that's great. I have $10K available for me to take out every month. But remember, when you take on debt to buy this business, which you almost certainly will, either through something like an SBA loan, or if you have owner financing, you'll be paying the owner back, you have to subtract your debt payments from that 10K to get what I call true cash flow. So let's imagine that you're going to be paying the owner of this business $7,000 a month for the purchase of the business, minus $7K. Well, then we would only have $3,000 left over for you to invest in new things in the business, pay yourself. We got to save taxes still on that money. Look at that true cash flow number, profit minus debt repayments. That is the number I want to measure. If that number is negative or break even, why would I be doing this deal unless I feel like I have a specialized skill set so that I can come in and change all of these profitability numbers? If not, I'm making a big risk that I might just figure out what to do that this owner who's had the business for years hasn't figured out yet. That is not a gamble I'm willing to take in most cases. And so if we assess true cash flow, we can get very specific as to whether or not we should buy the business. If you want to get our entire business buyer checklist and the workshop that goes along with it to figure out, is this business worth buying or not? I want you to click the link below and I will gift you our free training along with that checklist so that you can make a strong, informed decision. Thanks so much for watching, and we'll see you in the next episode.